Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. The purple highlighted late July to late August bearish shift pitchfork and the light green highlighted October to end November bull channel together made a bottom of sorts. However, the move up from this V bottom was capped in turn by the flatlining short medium moving average, currently at 1330, and that's highlighted in green on my daily chart. Then by the now slowly declining medium moving average in mauve, currently at 1349. After this, by the gold colored long moving average, currently 1379. And finally by a band of previously highlighted congestion between 1378 to 1409. All these resistances eventually eroded the move higher and in the process created a mini head and shoulders top over early November to early December. Last Friday the market broke down through the neckline of this mini head and shoulders top, highlighted in bright red. And that's currently at 1352, that's the neckline highlighted in bright red, which was coincident at the time with the lower bull channel line, currently 1359, and the 50% Fibonacci line of the late May to early July move at 1349. As you can imagine, breaking two trend lines so closely associated with each other, as well as a 50% Fibonacci line, required some considerable force, and prices have since dropped to some light congestion from lesser Fibonacci's line at 1312. So, with these moves lower, it is seemingly time to lay out some potentials below for this move down. Thus, for the mini head and shoulders top, we have a primary target in the 1312 zone, with a harder to reach secondary target X in the 1277 zone. For the bull channel, we have a primary target X1 not too far away in the 1308 zone, with a secondary hard to reach target X2 down in the 1270 zone. As you can see, today the market reached the primary target zone for the mini head and shoulders top in the 1312 zone. However, whilst it has been a significant move lower, it has not been wholly convincing. So just for the next week, as a caution, keep an eye on any retracements higher in case the break lower becomes a false break. Chicago soybean meal. 8 weeks ago, the market started a journey higher, up and away from a late July to late August bearish shift pitchfork that turned into a bear channel of sorts, and up through significant resistances provided by the short medium moving average, which is highlighted in green, currently at 412.5, the mauve colored medium moving average, currently 411.30, the 50% Fibonacci line of the October 2021 to March 2023 move at 403.60, the gold colored long moving average, currently at 421.10, the more recent 50% Fibonacci line from October to November at 413.60, and the interesting neckline of the old December 2021 to June 2022 head and shoulders top, currently 438.80, which is highlighted in dark blue on my daily chart. All these became supports, but by late November the market was tested lower again after establishing a horn top in mid-November, something I'd cautioned about 3 weeks ago. Prices dropped down through all these supports again, most recently testing the combination of the 50% Fibonacci line at 413.60, the slowly declining medium moving average, and the still rising short medium moving average. This has led us to where we are now, potentially hesitating around the 50% Fibonacci line at 413.60 and the short medium moving average and the medium moving average. Now, if this hesitation continues, which it's looking like it may not, then it could possibly be seen as a mirror image of the hesitation we saw on the way back up, back in late October, early November, that ended up being a bullish halfway hesitation. It's still too early to say for sure whether this is a mirror image, but I think a caution about possibly being such is appropriate, especially with today's move. Thus, if it is so, then you could look for a second leg lower to maybe down to the 382.5 zone or thereabouts. However, it will depend on what the market does on the coming week, and especially what it does at the three previously mentioned resistances overhead, and what it does at the 50% Fibonacci line below. And that's at 403.60, and we're testing that right now. This brings me to my final point. It's one I've repeated many, many times. 26 weeks ago. 26 weeks ago. And ever since then, I quote, on my long-term monthly charts, 2023 is set up to be possibly an annual key reversal. Thus, if we were to close on New Year's Eve either above 471 or under 399.10, then we'd be on. Anything in between would have a lesser outside year, end of quote. Right now we're looking at an annual outside year, but whilst we still have some time to change that, the sands of the hourglass are rapidly emptying and time is running out. Chicago soybean oil. The September to November bear channel, highlighted in dark blue on my daily chart, had been the main driver lower in this market over autumn. The main congestion band between 56.34 to 59.44 was overcome by early October, and prices pushed lower, easily down through the February 2013 high at 54.15 and the March 2013 high at 51.26, though not so through the interesting 38.2% Fibonacci line of the big March 2020 to April 22 move at 48.95. This surprising support slowed and stopped the market, turning it higher, and 4 weeks ago caused a break higher up through the upper bear channel line and creating a nascent bull channel, which is highlighted in bright red on my daily chart. However, this 4-week-old bull channel has run out of steam, capped by the combination of the sine wave highlighted in green of the declining short medium moving average, currently at 52.73, and the February 2013 high at 54.15. By the time we come to this week, prices have broken out below the nascent bull channel line, currently at 51.06, though the move lower has not been that simple. You see, this market now has a choice to either form a W bottoms type with the bear channel and have a potential back up to the 58 even area, or to break lower below the 38.2% Fibonacci line and form a very extensive bearish halfway hesitation, with the bear channel being one leg and the bull channel being the hesitation and the potential being as low as 40 even. I am not advocating either of these ideas, not yet at least, but these two seem to be the choices the market has right now. What I can do is retire right after this commentary, targets X at 57.85 and target X1 at 62 even, the previously laid potential for the break higher from the original bear channel. Finally, and this refers to an earlier commentary I made a few weeks ago about the larger descending wedge pattern seen at the start of this year. I said the following some 23 weeks ago, and I've done so since. And I quote, "I would consider the descending wedge pattern just may have lately morphed into a possible scallop pattern," end of quote. I will not expand on this idea any further at this time, as it is a big pattern and it also still early on in it. But the recent market decline fits in with this idea, with the expectations I voiced of eventually witnessing a fall down to the area of the May and June lows between 48 to 46 zone, which we have just about done. I'm now keeping a close eye on this idea, as any significant breakdown below the 48 to 46 area could signal the start of this move lower, and likewise any reversion back up to the peak where we have the head and shoulders pattern in June and July, well, that could signal the alternate break upwards. Two things to bear in mind. This is a really big pattern stretching from November 2022 to date, so do not expect any immediate sharp movements. Secondly, data indicates about 3 out of 4 times the market breaks lower. That doesn't mean it will be here, but please just be aware of that fact.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final important bit.